Good morning and welcome to the B.F. Anderson Technical Report for March the 18th. We're doing this a day early just because of market conditions. We're all at home. Everybody's having to hunker down. And the most important advice I could give you right now is you really need to be on top of your portfolio. You need to be aware of what companies you may have, whether it's in a fund, you may have mutual funds or exchange-traded funds or hedge funds. You need to really sit down and take a little bit of time and look at what's in those funds. You want to understand what these guys have invested in. Now, as a free service of our firm, we'll be happy to help you with that. It's a very simple process that we can show you how to do it yourself as well. So let's just take a look at what's going on. This is a bear market. You can see here that starting in mid-February, we started to see some problems here with the Nasdaq. Major waterfall decline. We are trying to make a bottom in here, but who knows? This is not the time to be a hero. Just simply wait. The market will consolidate. There will be a bottom put in. We just don't know where. And the economic conditions are not good right now. Especially the most important thing also is do not, and I repeat, do not chase high dividend paying stocks, especially in the energy area. It could be a trap. These companies may have to cut their dividends. And, I'm a big proponent of companies retaining cash so that when times like this come along, they don't have to lay people off and so forth. Now, on the weekly Nasdaq, again, we are below the 35-week moving average, and it looks like we're going into the second week below the 35-week moving average. We would define this as the beginnings of a bear market. Now, on the aggression index, it's pretty straightforward. You can see here a major breakdown. This is a ratio of technology stocks to consumer staples, things like toothpaste, tobacco, beer, so forth. So you can see here that investors are not aggressive. It has broken below the lower moving average. The upper moving average has turned down. Caution here. This is not a time to be aggressive. On the global stocks, you can see basically a major plummet. Now realize this is a monthly graph, and we are monitoring what we call the 10-20, which is the 10-month and the 20-month moving average. We look like we're going to get a death cross here. If this continues to hold down below the lower moving average, the upper moving average will eventually cross and we'll get a death cross. Now you can also see here on the MACD, which is the moving average convergence divergence, we are getting a major amount of momentum to the downside, so damage is being done to the global stocks as well. On the small caps, again, we're watching these closely. Never made a new high like the rest of the indexes. That was your warning. Basically a divergence. You can see the breakdown here. The index is down at this point right here. We are on a death cross on the 10-20 moving averages. Again, the MACD moving averages are showing a lot of negative momentum here. Be very cautious and keep an eye on the small caps. Small caps are much more important to watch right now than the Dow or the S&P or the Nasdaq, because it's these small businesses that are going to really have a tough time in here. S&P 500, we're still on a golden cross, but we are seeing deterioration. If the index continues to stay down here, we will get a death cross. And again, you can see on the MACD, we're getting negative momentum. Value line geometric. Now, this is a equally weighted index of 1,700 stocks. It's very similar to the small caps. And as you can see, they're breaking down, and we're possibly in we are on a death cross, but not improving, and at the same time, a lot of negative momentum. Now, this is China. We were getting a little optimistic about China. However, we have flipped, and we're now going into a death cross on China. Index is below. And now, what this is every Chinese company that trades on our exchanges. This is important because these are the highest quality Chinese companies, and we've now got a sell signal on the MACD, so kind of forget about China right now. Now, the only positive news is the fact that sentiment, this is the put-call ratio, we're getting extreme pessimism, extreme readings. This is how market bottoms are made. So we get hot, and we get cold, and we're very cold right now. So the question is, how long do we stay cold? That's why this is a secondary indicator. Now, what we have said here last week and the last couple of weeks, we want to look for a process, a bottoming process. It will not more than likely be a point in time like a V bottom. This could be an L bottom. This could be a U bottom. It could be a W bottom. You just don't know. But the main thing is, as you can see here, we're still in a decline. We're still in a downtrend. Then if we take the 200-day moving average, which is this blue line right here, you can see we're below the 200-day moving average and continuing to turn down. Not seeing any form of a bottom yet, so keep an eye on things. Now, the three areas for the economy that I think are important will be interest rates. As you can see here, interest rates got down here to around 0.5%. They've now climbed dramatically, back up to 1.1. So if you would have bought bonds in here, you'd really be hurting here. So just be aware of that. On oil prices, we're seeing oil right now below $30 a barrel. In a downtrend, I would really be very cautious about having heavy positions in energy stocks. Exxon announced this morning that they're borrowing over $8 billion, and they're going to maintain the dividend, which I think is really a sign of poor management, but they got to do what they got to do. See, these dividends, what happens is with companies like Exxon, the only reason people own the stock is to get the dividend. There's no growth. So therefore, if they cut that dividend, which is possible, you're going to have a real problem there. And if the price of oil stays down at these levels, that's probably going to be what's going to happen. Now, these are the small caps. Okay, so we've got the interest rate picture. We understand that. Oil is in a downtrend, and the small cap stocks are in a downtrend. Again, caution is to be advised. Now, what I did here is I wanted to show the 1020, which is a monthly moving average, just to show you how a bottom can possibly look. This particular drop that we're getting in the market at this time is somewhat like the crash of 87. So you can see here, 87, big drop, stabilized. Then we got the death cross, but then shortly thereafter we got the golden cross, and we were back in an uptrend. That may be what's getting ready to happen. But if we look at other bottoms, like here's the bottom that was in 2000. Again, you can see the golden cross after a death cross up here. So you had the warning here. It came down dramatically. Now you've gotten the golden cross. Then we get into 08. What I have to tell people is this isn't my first rodeo. I've been through these bear markets. I went through this period. I've gone through this period, and I've gone through this period. And let me just say this: you learn a tremendous amount about the stock market when you go through these bear markets. This is a real education. Now you can see here the death cross, major drop. Then you got the golden cross, back in an uptrend. So what we're watching now is that the index has dropped below the two moving averages. No death cross yet, but it may be coming. Also, I wanted to take another look. This is the 25-day moving average and the 50-day moving average, where I have removed the index so you can kind of see what's going on. Now, the purpose of this is to look at the crash of 87. Now, this would be where if once you get a breakdown in the moving averages here in 87, then you see the bottom and you come out of it. Now, go down here, and this is the S&P using the 200-day moving average. You broke the 200-day moving average, you rallied, you gave a retest, and then you got going. So just be aware of the fact that more than likely this bottom has not been put in, and then once it is put in, you're probably going to get what we call a dead cat bounce, and then you're going to have a retest. So just be aware of this. Now, on the stocks that look interesting right now, these are the stocks that are just holding up the best for various reasons. I have not had time to research these companies, I hate to say, because my list is changing so rapidly. In fact, my list has my filtered list, which we start out with 3,500 stocks, we usually get down to about 70 on the first run. Right now we're down to 20. So it just shows you we're not finding very much. Now here's a stock here. Now realize here what we're doing. This is the 10-day moving average. This is the 50-day moving average. What you're looking for is like a very tight pattern like this here. And then you get the breakout. That is a healthy looking buy signal. But what I would be concerned about with this particular stock is too much volatility, too wild and woolly. Plus you look for what we call a volume signature. Now, it just so happens we are getting a positive volume signature on this stock, but because the pattern is so wide and loose, I just don't think I want to fool with it right now. This is Regeneron Pharmaceuticals. They are working for therapy on the coronavirus. They had the CEO on CNBC the other day. It is breaking out. You do have the volume signature, but then again, you see this wild and woolly pattern, and I would rather have something that looks like this. So I'm spoiled on that. Now, this is a Chinese company, as we noted earlier. We've been watching China, but this particular stock is on a sell signal. We have broken down below the 50-day. We actually got the sell signal, I'd want to say back in this area here around mid-February, where you got a break below the 10-day moving average, and then you got a violation of the moving average. Would have told you to pretty much stay away. Here's a company called Teladoc. This is involved in the virtual medicine where you can call your doctor on the phone and discuss things. But then again, you see the same old problem, just too wide and loose, too much volatility. It's hard to make money in a volatile market like this. And I'll also say it's impossible to make money if you're long stocks to make money in a bear market, and we are in a bear market. So this is a time to hunker down, I'm just telling you. Vipshop Holdings, this is another retailer in China. Same problem. You can see how wild everything is, but it has broken down below the 10-day, broken down below the 50-day. I would stay clear. So if you have any questions or you want to reevaluate your mutual funds or your funds, give me a call, because we can show you a way that might bring you some comfort if you can at least understand what is in the fund. Let me know if you have any questions. Thank you very much.